See, I've had a lot of good feedback, so I don't think you have to worry about that. Now, we're here to help you become a better investor and help you navigate this changing market environment and invest for the future, not look at just what happened last year. The past is the past. And we're here to give you assessment of the current economic and market environment, as well as some actionable material that you can take back with you to make better decisions with your money. And we mainly do this by answering your finance and investment questions, but we also have our topics as well. And I actually really like our topics today, Luke. I think there's a lot to unpack and a lot for listeners to integrate into their decision-making process. Now, we're going to run down the market performance for today, as well as the show topics that we're going to hit on. But as always, we're going to hit our first caller question now.
Hey guys, I love the show. I got a quick question about 401k investing. My company offers a pre-tax allocation that I can invest in. I know what the difference is between a Roth IRA and a traditional IRA, but could you tell me what the difference is between a pre-tax contribution versus a Roth IRA? Thanks.
Pre-tax is just simply a traditional 401k, right? You're not paying tax on that. Pre-tax. A Roth contribution or Roth investments are post-tax, meaning you've paid the tax on that and you don't have to pay anything into the future. It's that simple. I think sometimes you get people get all fancy with the language, but it's that simple. Pre-tax is traditional IRA 401k. Post-tax is Roth IRA 401k. Pretty simple. Now, we have a lot of ground to cover over the next 40 minutes, and our main focus point is in regards to the Fed's favorite inflation gauge. Everyone talks about CPI, Luke, but we know the PCE, Personal Consumption Expenditures Price Index, is most important. That came out on Friday, so we're going to look at that and what that might mean for a potential Fed rate cut in the future and why the PCE index is mostly followed by the Fed. We also have other topics on the docket. Like I said, I really like them. Number one is the Sahm indicator. Sahm, is that, how would you pronounce that? Would you say it's Sahm? S-A-H-M?
It is Sahm, yes.
Sahm, there we go. The Sahm rule, not the indicator, Sahm rule. So we're going to look at that and and it basically is an indicator for a recession. And we're going to look at where we are today. Also, EV demand is taking a hit, and it's not just the Teslas of the world. It is really across the board, and not just domestic. It is foreign as well. A lot of foreign companies are reporting pretty soft demand in the EV market, so we're going to look at that. And then lastly, tomorrow is the Fed announcement, but almost equally as important, and I would argue even more important of an announcement, is from the Treasury. And that is in regards to the quarterly refunding announcement. There was the size of the amount of borrowing the government will be doing over the first and second quarter. That was announced yesterday. But how they're going to do it and those plans are going to be released tomorrow. So we're going to dig into that. I also have a fresh perspective ready to share in regards to the labor market and classifications of different employees and how that relates to the gig economy overall. Now let's take a look at the market today, Luke. It was kind of a mixed day, if I remember correctly. Yeah, mixed day. Large cap value up 0.45%, small cap growth down 0.91%. And that was kind of a hint at what you were going to see after hours. And you had Google and Microsoft report earnings. Microsoft looks mixed after hours, but Google is down 5-6% or so. Who else? There was another, AMD, I think, was down after hours as well. So certainly the news for today's market was more of what happened after hours during the earnings season as opposed to the intraday. What did you see?
Yeah, no, there's big reports out of Microsoft, Alphabet, like you mentioned, Wells Fargo. PayPal announced it was laying off about 10% of its workforce. And keeping in mind, this is in the wake of that big announcement a couple weeks ago where they said they were going to shock the world, and it was just some boilerplate AI tool integration, and PayPal stock dumped as well. But I think most eyes are like you mentioned, looking forward to the Fed meeting tomorrow. I saw that the JOLTS report came in, as well as consumer confidence, which pointed to a still strong labor market. So on the heels of that and the PCE index, it'll be interesting to note if the Fed starts to soften its language around, because keep in mind, in the recent past, they were talking about the possibility of an additional hike, which certainly nobody believed they were serious about, but still including it in the language leaves a slightly hawkish tone. So it'll be interesting to see how they change their narrative with the still strong labor market paired with easing of inflation.
And another news event after hours was not necessarily earnings, but a judge ruling against Elon Musk and his, wait for it, $55 billion. Yes, that is billion with a B, $55 billion pay package that was passed in 2018, Luke, was it?
2018, yes. And this is a judge who has been tough in the past on, let's say, exorbitant pay packages, keeping in mind at the time that was the largest pay package, may still be the largest pay package in public market history. Not too much of a surprise.
Just wait until this latest pay package that he's asking for. It might even exceed it, right?
Well, the reasoning from the judge, from what I saw, is that there didn't seem to be a good faith negotiation in the interest of shareholders, given the makeup of the board of directors at Tesla at the time. So certainly, given that reasoning, this may put some pause on whether or not they give it into his demands to allow him to have 25% of the company.
Yeah, it's been pretty clear throughout the history of Tesla that the board answers to Elon as opposed to Elon answering to the board. And that's not just this instance, but many, many instances in the past. So not a shock here, and it'll be very interesting to see how that ultimately shakes out. Obviously, that's probably going to be appealed and more litigation to come from that. But Tesla stock is down another about 4 or 5% after hours, which that could also be in sympathy to the other tech names kind of falling out of bed here a little bit. So very interesting after hours. I said on Monday, I guess that was yesterday, this is going to be a very eventful week. And it's certainly living up to that billing so far. And we'll get the ultimate moves tomorrow. Now we're going into a quick break. Please remember that you can call anytime and leave your questions on the InvestTalk voice bank. If you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART.
Every investor is working to build a secure financial future.
Would this be an opportune time to annuities?
Everyone's situation is different.
Get your thoughts on CRM, Salesforce.
And so are their questions.
And I was just calling for your assessment of Blackstone Incorporated.
To get your take on QE.
Ticker symbol LECO.
Just wanted to get your opinion on JP Morgan.
InvestTalk host
perspectives all day.
Justin Klein.
I'm okay paying a fair price for a very good business.
Steve Peasley.
It's a very well-run company.
And now Luke Guerrero.
EBITDA growth is significantly higher than its competitors.
Are ready to provide their unbiased answers. Each podcast is unique, and you set the agenda.
I will.
Hey, hi, Steve.
24/7, rain or shine, InvestTalk is made better by the power of you. Call 888-99-CHART. Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. That means you'll have finance and investment questions. So don't forget to call InvestTalk, 888-99-CHART.
Hey guys, this is Art from Tucson. Hey, I'm calling in about Intel, INTC. Wondering with this recent pullback if it'd be a good time to buy, thinking about the tailwinds the company might have with this government investment in chip companies and manufacturing in the States here. Just wondering what you think and where a good buying point would be, if not now. And I'll listen on the podcast. Appreciate all you do for us. Thanks.
Well, we do own Intel for some managed accounts, and it's been in a solid uptrend since late February. It bottomed at about $25 per share. Now, even after this pullback from around $50, it is at about $53 per share. It was overbought going into these earnings, but so it probably needed a bit of a refresher back to that 100-day moving average, which is right around $41 per share. That's probably where the next big support level will be. So not far from here. And the reason it had rallied, though, so dramatically over the past, let's call it year, is a turnaround in earnings. This year, earnings are expected to go up 34% and then another 60% next year. And this latest quarter, revenues were up 10% year over year, the first year over year increase in earnings in a couple of years. And earnings were up 260% year over year. So clearly the change in management is helping Intel overall, even though there's soft demand for PCs, for example. But Intel's business is becoming more and more diversified. And as the caller said, Luke, that there's a lot of incentive or a lot of tax incentives now for Intel to reinvest in domestic chip manufacturing. And that's going to benefit their cost structure in the long run. So I don't know. I think this pullback is an opportunity if you believe that they can reverse some of their market share losses that they gave to AMD throughout the last decade or so.
Yeah, no, I think that's a good take. Its price to book right now is 1.8 relative to its 5-year average of 2.4. But over the past couple of years, you've kind of seen, like you mentioned, the righting of the ship in terms of cash flow, in terms of profitability starting to take a turn as well. And that really shows in the bottom line earnings. But I do agree with you that Intel has the ability to take a turn and shift and kind of take away some of the dominance that some of these other tech names have had in the AI space. But like you mentioned, it takes some time. It takes some time to turn a massive corporation like that. The perfect example is the big car companies trying to turn to EVs. There are going to be some stumbles along the way, but it takes a time to move a large ship like Intel. But like you said, I do agree that maybe not exactly at this price. I'd maybe try and wait to see where the price discovery phase goes here after this most recent pullback. But I'd certainly keep this on my watch list moving forward.
And to me, Luca, this is actually what Boeing should take notice of. This rebound in the stock, in the price of Intel. Intel, for a number of years, it hired the former CFO as a CEO, and they look at the lens of the business through finances as opposed to innovating. And in a product business, innovation and quality should be top of mind. And luckily for Intel, they've gotten rid of that former CFO and they have a new CEO that used to be the CTO and focusing more on the technology side. Boeing still is stuck with that leadership that kind of has driven them into the ground. So it just goes to show you that a product business needs to focus on quality and innovation and not financialization. And when they can do that, they can potentially reclaim a lot of their market share and their glory days. So I think Intel is certainly on the right path. Certainly risky that things can change in the technology world. Things change all the time. But I like the trajectory that Intel is on at the moment. Now, as we go to a break, let me remind you to check out our new InvestTalk Classroom series, episode 16, titled The Residential Housing Market. Luke and I break down the current dynamics and help you understand how to think about your lifestyle goals when selecting a home. Just go over to YouTube and search InvestTalk Classroom. Now, the phone lines are open, waiting for your questions at 888-99-CHART.
Every investor is working to build a secure financial future. How they get there and when they get there, that depends on many variables. The more you learn about how the market works, the better your chances. So don't forget to call InvestTalk. 888-99-CHART.
Now, our main focus point today concerns the Fed's favorite inflation gauge, and that is the Personal Consumption Expenditures Price Index. That was announced on Friday for the month of December. So it's a bit lagging here, Luke. But what it showed was a 0.2% increase month over month and a 2.9% increase year over year. And if you actually look at this on a 6-month annualized basis, which the Fed did talk about, it's sub 2%. So this is the lowest level, 12-month rate level since March 2021. And it certainly gives the Fed a lot more potential ammunition to start cutting rates later this year, which the market has obviously priced in a big way. Do you think that this will continue to ebb as we go throughout the year?
It's certainly a possibility. I think that this, coupled with the strong labor market, though, and continuing of capital expenditures by businesses, may actually give the Fed reason to not cut as quickly as some people perceive that they will. I think that generally people have recency bias in thinking, well, if the Fed raised rates so quickly, then I imagine the campaign to cut them will be just as quick. Mm-hmm. But I think that it's probably more likely that they get down to the terminal rate of 2 to 3% over a course of years, rather than what the market expected. Remember, just several months ago, 150 basis points of cuts within 2024, which seems a little far-fetched with me. Because what this is showing me is, yes, they're doing a good job in terms of beating inflation, but the stickiest part of getting down to that 2% target is now. Right? Especially with a strong labor market, it's going to be more difficult with wages rising and that strength in the private markets and to get inflation down to that 2% target. So I think they're going to probably be a little bit more cautious than the market expects.
Yeah, you have to remember that the Fed, while it has been talking a lot about inflation recently, it can easily focus more on the growth side of the market or the economy. And unless that growth falters, right? If the inflation rate is near the target, which on a 6-month annualized basis, that's true. It's kind of right at its target. Then now they focus on growth, and growth is fine. No reason to cut rates. Certainly not growing gangbusters, but that 3.3 in the fourth quarter, 3.1% annualized GDP growth for the full year 2023. So clearly, we're not in the recession for them to be super aggressive. But I do think that inflation will continue to ebb throughout this year, at least the first half of this year, because what you're getting is that flow through from M2 growth. And I talk about this a lot because it's very important to understand. And if you look at a chart, M2 growth peaked out in January of 2021. So it took off basically in March of 2020 when all the COVID stimulus packages were put out there and the Fed was easing dramatically, putting rates at zero, and the whole world was shut down. But the monetary and fiscal spigots were turning on big time. And you actually peaked out in year-over-year M2 growth at 25.73% in January of 2021. And that the core PCE price index peaked out in February of 2022, so a little over a year. So between a year and 18 months after that peak is kind of when inflation peaked out when I'm talking about M2 growth. And if you look back about a year or so from where we are today, year to 18 months, 18 months ago, you were at, about 5% year over year M2 growth. A year ago, in December, we were actually negative M2 growth, slightly negative, 0.89%. So what it's showing you is that you're still in this period of decelerating inflation. Now, once you get out to the middle of the year, so the lowest point in year over year M2 growth was in March of 2023, April of 2023, last year. That was at negative 4.5%. And actually that M2 growth has slowly gotten a little bit higher. It's still in negative territory at negative 2.3%, but it's gotten slowly, less negative throughout since April of last year. So my point here is that inflation should ebb through the middle part of this year, roughly, and then that's when you get the stickiness. and potentially an increase in inflation in the back half. And that'll be interesting going into the election to see how much that impacts their policy and thus market trends. And that will be something to watch. Near term, I don't think there's any issue, but as we get in the back half, that will be something I'll be keeping an eye on, that's for sure. Well, on the next Invest Talk, we'll look into this question. Can a taxable account beat a 401k? Investment quality and expenses, as well as tax costs, are big swing factors. That story for us to discuss tomorrow. But for now, I'm Justin Klein with Luke Guerrero, and we're ready to take your calls at 888-99-CHART.
InvestTalk is here to help. And when you download the free InvestTalk podcasts, don't forget to rate and review. The phone lines are open, 888-99-CHART.
Hey, Justin, I saw the movie Dumb Money, and it was a very good movie. Filthy rap music in there. Didn't like that part of it, but the movie was well done. Curious if you saw it. Would you like to comment? Maybe educate some of us that saw that movie and wonder, hey, did we miss that on a great chance? Or, just pretty much the whole fundamentals of how that thing played out. It was interesting. I never got in there. Really like the show. We're praying for Steve. I hope he gets better. You guys are doing a great job. I appreciate everything. Thank you.
Well, first, thank you for your kind words regarding Steve. I think we're all praying that he gets better and back to us soon. But I personally, Justin, I don't know if you've seen it. I haven't seen.
I have not.
The movie Dumb Money, but I certainly lived through the events, being that I worked at a pretty large fund at the time of the Wall Street bets bid up of GameStop and that ensuing short squeeze. But I do think that the lesson from the entire course of events regarding GameStop, at least from my perspective, I think people tend to see it as an example of retail investors sticking it to the man being hedge funds. But at the end of the day, the people that made the real dumb money was Wall Street. Mm-hmm. Plenty of the shares outstanding of GameStop were held by large firms. And a lot of them, I know, sold at the top. And so the lesson that I try and tell investors and clients and anybody who asked about this at my old job and at KPP is that if you hear about something in the news or you hear about something on Wall Street bets, chances are it's too late to get in. Because at the end of the day, yes, Melvin Capital folded, I believe, the hedge fund that was really short squeezed out of existence. But the people that were left holding the bag, so to speak, were retail investors, ones that were promised riches, because at the end of the day, most people don't get into investing to stick it to the man and break the system. Most people get in to try and make a better life for themselves. And those retail investors that were left holding the bag, GameStop and some still are, sold a bill of goods, are worse off for it. What are your thoughts?
Yeah, if you look at the chart, it started back in, September timeframe is when it started to move of 2020. And it peaked out in late January of 2021. So you're talking about a 4 or 5 month period here where, it had a lot of volatility, and then you had that big surge higher, peaked out at a high. What was the high here? $120.75. And ever since then, it's been trending lower, making a series of lower highs and lower lows, and now it's trading at $14.55. So it's, as a trade, as an interesting story, everything kind of lined up. Everybody was terminally online because they were not working, or at least they were working remotely, and they had they had plenty of time to browse Reddit boards and Wall Street Bets board, right?
That's the one.
And then the liquidity was flowing abundantly, both from fiscal and monetary. So there was a lot of things lining up to create a short squeeze. And that happened. And those that were able to ride that, they earned a big return. But how many of them actually sold? Probably not very many. So it was probably the rarity of the people that got into the whole GameStop thing that actually made big returns. So no, I don't think you missed out on a whole lot. And it just goes to show you that kind of anything can happen in markets, especially when various factors line up, and you need various factors to line up to have something as crazy as this was. But it's all speculation. It has nothing to do with investing. And that's the moral of the story here is in the trading world, anybody can get lucky. But when it comes to investing, this is not a way to pick names to buy and hold in your portfolio, because obviously this is down nearly 90% from its all-time high. Anything to
add? Well, actually, one thing that it did do was kind of shine a light on payment for order flow. Mm-hmm. For those who don't know that, that's a practice where a brokerage firm received compensation from a market maker for routing those trades there. It's how Robinhood is free for investors. So that was good. That's a practice that has some sketchy history. That was a benefit of it. But overall, like I said before, a lot of people were left in a way worse spot, sold a bill of goods, promised riches, and invested their retirement. So always be careful. When something seems too good to be true, chances are it is.
And I would be very interested to see the data from like a Robinhood, and to see all the GameStop trades over the past, what are we now, 3 years or so, 3.5 years since that, and how many of them actually made money. What was the net profit of those trades? And I can almost guarantee you it's negative, because most people don't have the discipline to take profits when things are going really well. They think that the tree will grow to the sky, and that's one phrase that my grandfather always repeated, and I've taken to this day, which is no tree grows to the sky. And you have to be cognizant of that. Usually when you feel the best about something, that's the time to take some chips off the table, and vice versa. When things look as dire as they possibly could be, that's when you want to grin and bear it and probably buy a bit more. So that was the end lesson, I think, from the GameStop fiasco. Now, our perspective today concerns the new Department of Labor classifications around the gig economy and the distinction between independent contractor and employee. And obviously, this is very important in this new world where the projection is, Luke, 76.4 million people in 2024 will be classified as, or working in the gig economy, excuse me. And that's up from 73.3 million freelancers estimated in 2023. So this isn't a small cohort of the population. Remember, the working age population in this country is about 200 million. So it's not the majority of people that are freelancers, 1099 employees, but it's a lot. So, this really applies to the Lyfts, the Ubers, the DoorDashes. I know we had a call yesterday about Lyft, right? And the big question is, what is this rule? How's this rule going to evolve? I know, was it here in California, they created a new classification of worker that...
It was, that was Prop 22 that was bankrolled by the rideshare companies, I believe.
Yeah, and that passed, correct?
It did, yes.
Yeah. So you think that this will probably be something that happens on the federal level, or do you think it's going to be state by state?
Probably be state by state. I know it was tied up in court for a while. It looks like the original ruling that parts of the bill was unconstitutional was in 2021. That got reversed on appeal, and now it's awaiting review by the California Supreme Court. So it's an incredibly complex issue that probably the states will be the test cases for before they move anything federal. But I would point out that certainly the past 12 months has been the season of labor. There's been a lot of union victories. Laborers have done really well. So I think the climate in which this was passed was a different world compared to the past 12 months. So I don't know if something like that would work federally.
Well, on a federal side, the Supreme Court has offered guidelines that distinguishes employees from independent contractors. So they look at various things. So it's is the service an integral part of the employer's business? And the greater the integration, it favors more of an employee-employer relationship. I would argue that nothing is more integral to the business of Uber or Lyft or DoorDash than their actual drivers. Otherwise, their service cannot be executed on, right? They also talk about the permanence of the relationship. More established relationships favor employee status. So that would probably argue against it, because there are some Uber drivers that ride for Lyft and then do DoorDash and then do Uber, right? And so there's probably not a lot of permanence there. So that probably argues against it. Then it's the amount of invested in equipment. So when a worker makes a significant investment in their equipment they use in working for someone else, they suggest an independent contractor relationship. So that, once again, argues more towards independent contractor, because Uber and Lyft are not supplying the cars. These drivers are supplying their main piece of equipment, which is the car. Then the degree of control by the principal. So more control favors employee-employer status. This, once again, argues more of an independent contractor, that these people can work as little or as much as they want. And then lastly, the amount of financial risk. More opportunity for profit or loss favors an independent contractor relationship. And I would argue that's against it, because there's not a whole lot of upside, also not a whole lot of downside, because you could just not work and you're not losing money. Okay, so there's not a lot of financial risk there. So that's why I think it's a hard one to figure out, and probably needs a new set of classifications that is called something else, not an independent contractor. Maybe it is the gig economy bill that kind of threads the needle a little bit. And I think that is probably, in many ways, the biggest risk to those Ubers and Lyfts and DoorDashes of the world, is that there will be some middle ground. Because right now they're pretty much independent contractors, which gets them off the hook for payroll tax and insurance and all these overhead costs that the average employer has to pay for. So regulation is, in my mind, Luke, an underappreciated aspect of investing when you're trying to game what that looks like, especially for big players in disrupting industries. Governments are often behind the curve in actually finding ways to regulate these new industries. But over time, they do tend to kind of get their hands dirty and make something happen there. So I don't know. What are your thoughts? How do you think that applies to the Ubers and Lyfts of the world?
Well, redundancy, for the sake of clarity, legislative and regulatory risk are things that investors cannot ignore.
Yeah.
Which is something that I think we mentioned yesterday when talking about Lyft. And so when you have these companies like Uber, like Lyft, like any of the food delivery companies, anything within the gig economy, it's a new frontier of a workforce. And the only thing you can be certain of, in my opinion, is that the current status quo and applying laws from the traditional labor force to this new type of economy isn't going to last. There will be changes. We don't know what they will be, but there will be changes, and they will affect the bottom line of these companies.
Yeah, and with, like I said, how lax the current rules are towards these companies, I think it can only go the other direction and cause them more expenses going forward. Now let's go to Bill in Northern California, who wants to look at Zoetis, ZTS.
Zoetis, yeah.
Yeah, hey, you own it or looking to buy it?
I'm looking to buy it. I had it last year, and I had bought on a dip like a year ago, and I had some shares I had bought in a smaller amount. And I just thought when I got a few bucks above that last month, and I just decided to sell the whole position. It was relatively small. I was waiting for a pullback to the 150s. It started getting down there, and then it missed my price. I set it too low, and so I'm just like, there'll be another pullback. But tell me how much you like this and what you imagine it might pull back to. It seems like a pretty healthy company.
Well, you're right that it is a healthy company when it comes to earnings and cash flow, but like all things, it's not always just about the quality of the business, but the price you pay for the business. And currently, the price to pay for this business is pretty steep. Enterprise value is around $93 billion and a free cash flow of about $1.5 billion. So you're talking here about a 1.5% free cash flow yield. That is pretty low, especially for net. Now, I might say, okay, that makes sense because of growth, but the growth is now not that great. It was growing dramatically, but last quarter revenues were up 7%, earnings up 12%. This year, earnings are expected to be up 11%, which is solid, but does it deserve a market multiple that's double what the market's paying? Probably not. So I think that's the issue here, and it hasn't come even close to its all-time highs at the peak in late 2021, late 2021, early 2022. And that bodes poorly, I think, from a technical perspective, and the fact that it's still trading at a very high multiple, 10 times, almost 11 times price to sales ratio. That's extreme. Enterprise value to EBIT around 25 times, which is high for most companies. And so I actually think this is right before. I think you'll get to 150 and probably lower. I wouldn't touch this probably, Luke, below 120 is probably where I would maybe start thinking about it, but it's got to go down a lot from here. What are your thoughts?
Yeah, I tend to agree. Its price to book is 17, which is incredibly high relative to its peers. It's also only 3.7% off its 52-week high versus the subsector average. So it's run up quite a bit as well. To me, looking at the chart, looking at the fundamentals, looking at the relative valuations, it looks right for a pullback to me. So I don't think right now is the time to buy it. Just because you missed your initial buy-in price doesn't mean it's not going to revisit it.
Yeah, like I said, it's got to be below 120 for me to even think about it. Now, on the next Invest Talk, we'll look into this question. Can a taxable account beat a 401k? Investment quality and expenses, as well as tax costs, are big swing factors, which we will dig into tomorrow. But for now, I'm Justin Klein with Luke Guerrero, and we're ready to take your calls at 888-99-CHART.
No two portfolios are alike, and every investor has a unique set of circumstances. So don't forget to call InvestTalk, 888-99-CHART.
Hi, this is Kevin calling from Southern California. First off, I want to wish Steve all the best. I hope that his treatments are successful and he'll be back on the podcast soon. Recently, you guys were talking about 529s. I'm wondering if it's better to hold the 529s in my name and my wife's name versus holding them in my kids' names, just because I know that they would need to be claimed on like financial aid applications. So I'm wondering if it's better to hold them in my name until they actually are about to use it for education, and then transfer it over to their name when the time comes. Hopefully we can hear your thoughts on the show. Thank you.
Well, this is more of a FAFSA question. And frankly, I don't know. Do you know this, Luke?
Yeah, so as recently as last year, if a parent owns a 529 plan, for FAFSA, it's assessed at a maximum rate of about 5.5%, 5.64%, versus when a child, when it's under their name, it can be up to 20% in the FAFSA formula.
So it makes sense.
At least from a pure federal student aid impact perspective, you do benefit from having it in the parent's name versus the child's name.
Okay. There you go. That makes sense. Well, lastly, let's talk a little bit about the Sahm rule. And there are a lot of recession indicators, but there's one indicator that is accurately called every recession since 1960, and this is coming from Claudia Sahm. She is a Federal Reserve economist, and she suggested an indicator that was very simple. it looks at the 3-month moving average of U.S. unemployment rate. And when this moving average rises 0.5% above or more the previous 12-month low, it signals the beginning of a recession. So, Luke, what's the 3-month moving average of the unemployment rate? It's 3.73, and the 12-month low is 3.4. Okay, 3.4. So it hasn't triggered quite yet. This is actually tracked by the St. Louis Federal Reserve Bank. So this is not something that just the average person looks at. The Fed is looking at this as well. And this has flashed a signal in every recession since 1960. So should we just follow this?
Well, I think the difficulty is if you're looking for an indicator before something happens or as something is going into it, that's incredibly difficult. So although this has triggered during every recession that is included in the data set, I believe that it's not always triggered as a precursor as you're going in. So it has missed the beginning of it. So does this tell you if you're in a recession? It has. Mm-hmm. Can it be a reliable predictor before it happens or as it's starting to happen? Not exactly sure that's the case.
Yeah.
But I think the general rule or the general plan that you should have is to, in times of where you believe there is going to be economic stress, plan well ahead and prepare your portfolio for a recession, something that I believe we've done a webinar on. Yeah. So that can be helpful for any investor, regardless of when it happens, if this can tell you it's today, tomorrow, or next week.
Yeah, the indicator usually flashes a few months after the start of a recession. Sometimes it has flashed before the actual recession happens. Remember, the National Bureau of Economic Research, they're the ones that declares we were in a recession. But that usually doesn't happen until after the recession either, right? Usually in retrospect, they say, oh yeah, the recession started 9 months ago and it recently ended, or we're in it now, or whatever, right? So there's no 100% reliable indicator, but this is pretty good, at least saying at the very minimum, we're in a recession or not. And a lot of people want to argue we're in one now, and it's pretty clear based on a lot of indicators, including the Sahm rule, that we're not quite there, even if the economy is generally mildly weakening. Now, I'm Justin Klein. Along with Luke Guerrero, this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis,